Thank you for joining me. I'm Juan, lead trader and founder of ProsperiTrade. In this video, I want to discuss value investing versus high-risk swing trading. And I want to address the elephant in the room, FBRX, and lessons we can learn from FBRX. You're going to want to watch this video. So before we begin, let's review our portfolio. So this is my growth portfolio. These are growth stocks that I have. Growth stocks are different than value stocks. Value stocks, you're basically finding companies that are well established. They have some positive trends. They have upside in revenue. They're trading at a price that's considered a discount according to their intrinsic value. So you're basically paying 70 cents, 60 cents, 80 cents for a dollar. Growth stocks, you expect exponential growth over the next couple of years. You like the company, the technology, they're doing something way different. It may not be a well-established stock, but you feel like they're right at the brink of changing. And that's what a lot of these companies are. EXAS, it's down 16%. SCNS, Senseonics, has been heating up. We've been in this stock since March. And at March, we got in at 289, up 35%. They're about to come out with their 180-day CGM device. And they're one of the most accurate CGM devices out in the market right now, which is great news. Then we have MP, which is a great green play. Palantir, Gold, SMTI, which went up 48%. DNMR, AMD, which closed out, which was a leap option. SMLR, which is a great company. And DOCN is another company that I'm about to close out because it's about to hit my target price. So my swing trading portfolio is up 90%, which on the surface seems great. But let's break it down. So NEO up 10%. BLRX, it went up to 90%. It hit our target and it exceeded it. It went up to $6+. SRNE hit our target and exceeded it, up 28%. DARE, I got out early, but it did hit the target of +$2. I didn't take the full profit. DTA was our first loss at 20%, 380. Cara was a great trade, 12 to 15. 1470 was my price target. It went as high as 19. PDD, 91 to 98, 7%. And FBRX, an 82% loss. Even though I had a $26 stop loss, and if you watch the video, I mentioned the stop loss at $26. I felt like that's where support was. This thing dropped so quickly that there was no way you could have gotten out at that stop loss. And if you had some stop loss limit orders, it was after hours, so they would have not been hit. Now, even with this 80% loss, if you took every trade with me, you would still be up 90%, even with the 80% loss. I was up over 170% total this year before FBRX. So it's been 3 days since FBRX came out with this terrible news, and I didn't make a video yet for a few reasons. One, I felt terrible. I felt like I let a lot of people down. I felt like anyone who traded this because they trusted me because I've had great success in the past. I've had high recommendations from other YouTubers, other influencers, other stock investor personalities have recommended me. I felt like I let all those people down, and it was tough to swallow. That was something that I've never had to deal with, and I've never in my career of over 10 years gotten into a trade and watched it drop 80%. So this was a first. This was humbling. You start getting all these gains and people start praising you. It feels good. I'm not saying you become arrogant, but it feels good. You know, the praise, you feel like you're doing something good. You're doing well in your field. You have a great product and you're offering a great service. And I don't charge for anything. And it just felt like I was doing something for my community. But after this, you get those comments. This is with this video, FBRX, it's my most commented video I've ever received. I don't have a huge channel, but this was the most commented video. It was hard to deal with that. So I've been dealing with that the last 3 days. Then I just started going through my process again of reading through companies and trying to find a trend, what was different from this company than every other company. And there were two things that stuck out in my last few days of research. One, there was a lot less peer review information on their product. as opposed to other companies in the past had more peer-reviewed information, had more journals, articles in it. So that was the first thing, and that's a rule that I can implement next time, that any biomedical stock company I pick, I have to make sure that there's enough peer-reviewed studies, enough articles, enough maybe something in the American journals. There has to be more of that. But the second thing, and it seems like the most obvious, but I guess I didn't think about it at the time, was that this is the only company out of any company I've ever recommended that only had one product. And I think that is the key thing that I'm getting out of this. I don't care next time if a company is promising to make a pill that will cure every disease in the world. If that's the only product they have and it hasn't even received FDA approval yet, and they're solely depending on that, they don't have anything else, then I'm gonna have to just stay away or invest in it if I feel comfortable, but not make a video about it or not recommend it. I don't know if I felt pressure, rushed, felt too comfortable, felt like I was past perfect, because I mean, 170% growth is definitely a great portfolio. So I don't know if any of those things played a role, but I know that I definitely should have thought about, even though I liked what the product that they had, I felt like it was going to be a good product, a good alternative. There wasn't enough peer review studies, but more important, it was the only product that this company had. So that is the biggest thing. And someone put that in the comments too. I read it later, and that's a great point. That person, they called it out on me. It's something I missed. It's something I didn't think about. This is something that's just never happened to me before. I've never had to get this deep into one of my losses. I used to journal my losses when I used to day trade, which I still day trade occasionally. I used to journal any gains, losses, and look for patterns. But those are little trades, little losses. You know, a loss of $50, $100, or this is 80% loss. I've never had anything this major before. I looked over it, and those are the only two things that I would have done differently. I hope, you know, if you've been trading with me in the past and you were up 170%, let's say you invested 10,000 and you were up 17,000 in profit, then you gave back 80% of that 17,000. And I've talked to other investors, friends that have large portfolios, and they've made, like, over the last 3 years, a couple million, and they sometimes tell me like things like it's nothing, like, oh, my portfolio's down 20% ever since the correction. I'm down 600,000 this month. And they say it like it's nothing, but it's 20% of their profit, you know, and that's the biggest difference. So if you've been trading with me since the beginning, this would be 80% of your profit, which is still ridiculous. I mean, even repeating 80%, it feels crazy. But if this was your first trade with me, and this is your first impression of me, I don't know how I can regain someone's trust other than I'm going to try harder. I'm going to work harder. This is something that's never happened to me before. You can look at all the other trades. You can watch my videos when I called stocks out to confirm that, hey, yeah, this was a 90% gain. This was a 30% gain. This was a 30% gain, 23% gain consistently. You can look at the growth stocks, the same thing. I hope I get a chance to gain anyone's trust that is new to this channel. And if you've been here in the past, and you know, I don't have enough history other than these stocks here to show that, oh, this is a consistent trait. All I can say is this has never happened to me before, and I don't think it will ever happen again. I hope not. You know, I hope not. I'm going to take some of those precautions and just learn my lessons from this trade. Value investing. So what is value investing, and what's my process for value investing? So my process for value investing, I'm looking for stocks. So I have a scanner, one that I set up on Finviz. So if you look here on my saved scanners, I have possible reverses, possible reverse below the 20 EMA. This is more for like swing trading, day trading. Strong company undervalued, possible bounces. This is reversal, swing tradings, performance up, companies that have been uptrending. And then, so strong fundamentals, they've had positive growth, positive net margin, positive under 20 PE, positive return on assets, under 1 for debt to equity, positive free cash flow, positive sales growth in the past 5 years, just all positive. And then I'll have like RSI oversold, and I'll get a bunch of charts. and I'll just start looking. So I got Big Lots, FedEx. So that doesn't mean that all of these are tradable. I'll look at these. I'll look at the patterns. I know they have good fundamentals. I'll narrow it down. So only about 7 popped up. So once I get a bunch of stocks here, I mean, if it's a company that I feel like is crashing or no good, so Big Lots would be interesting maybe to look up. FedEx. Once I get a list of stocks like this, I got another phase that I go through, and I'll show that here. This is the first thing I do with one of the companies I choose. I kind of do a basic DCF, and I use free cash flow to kind of give me an intrinsic value. I kind of do this first because right off the back, if I still feel this company is expensive, then it's not a good value play for me. I like having value plays in my portfolio because they're not going to get an 80% drop. And, even if they get bad earnings, sometimes they'll have a little drop and there'll just be more opportunity to buy. But eventually, over the year or the next year, usually they beat the S&P. So that's what we're looking for. We put in, for example, the previous 5 years of free cash flow, 2017 to 2018, it was 38% increase, and in 19, 24, 5. Then we kind of do a little digging and research and look at what analysts are estimating what their percentage of growth rate of free cash flow is going to be over the next 5 years, and we input that. So I felt like 3% was pretty conservative given them their free cash flow for their next few years. Then you put in their discounted rate, what their continuous growth is going to be past those 5 years, bringing that to the present, and those numbers pop up here. It gives you an enterprise value. You enter the financial liabilities, cash that they have. It gives you an equity value. You take their shares outstanding, and it gives you what an estimated fair value per share cash value is. So once this passes phase 1, I say, okay, this is greater than S&P growth. S&P growth 7 to 11%, 7 to 12%, whatever, 7 to 10%. As long as it's better than that, then I say, okay, let's go to phase 2. So phase 2, I have another DCF, and it's a little bit more detailed. Okay, so this one, all in blue, is the numbers that I'm going to put in. This one, instead of the free cash flow, I'm putting their revenue growth. And this is kind of like some of the criticism that Intel they've received. They haven't done much over the last few years, and they've definitely underperformed their competitors, which would be AMD and NVIDIA, AMD mainly. So they've underperformed them, but they still had some positive, steady revenue growth. This company has a lot of cash. This company's been around for a long time. Anyways, so I take their revenue growth, I enter their cost of revenue, I enter their R&D, their SG&A expenses, other expenses, get their EBIT, I enter their depreciation, amortization, and all these can be found on different websites, or you can just read the 10Q, 10K, and get like a lot of these numbers in there. Enter their capital expenditures. Then I hear this is from their quarterly. I put their current assets, their short-term cash investments, their current liability, portion of debt. And then this is where estimating comes. For example, based off of what I read, and this is if they don't, I feel like they have some catalyst coming up with their foundry, with their autonomous driving, with their new line of graphics cards coming up in 2022. So they have some stuff down the pipeline. But I put numbers, growth numbers, anticipating that nothing new is coming abroad. I'm not anticipating any of those new products or any new revenue other than what they had. So 1%, 0.3%, 0, -5, -0.5, -5%, 0.1, 0, 2, 0.6, 0. So very conservative. Then the last part that we enter is their current value of cash and equivalents, their current value of debt, their outstanding shares, and it gives me a fair value of $62. So once I have that down here, I have their fair cash value is what we got, 62. I enter here the last DCF that we got, the free cash flow one, which was 70, and I average them out, which gives me a $66 average price. To me, that's pretty safe. It has a 23% upside. So then once it passes these two, now, if it's a growth stock, I'll do another DCF, and I'll show you that right now. Okay, so you see here this DCF. Usually I do these because these are very, very time consuming. For more like growth companies that don't have as much free cash flow, or there's going to be a lot more estimates. So this is, for example, DOCN, which I just sent an alert on, which I sent an alert on when it was trading in the 50s, and it's currently $73. And I put their key business metrics, their market shares, their customers, ARPU. But what I do is I put 3 sets of numbers for each one. So a bullish case, base case, bearish. Bearish, worst case scenario. Base case, if they keep up at the pace that the current pace that they're at, and bullish if they exceed that, and whatever they think their potential is, if they're going to reach that, or whatever their market share is of whatever they're selling, if they feel they're going to capture a certain percentage of that. I kind of put in the best case scenario for that. It kind of does that for everything, even cost of revenue. You know, we have a bullish case for cost of revenue, and obviously if you're bullish, for example, here we believe that they're going to be 40, 43%, 40% cost of revenue, as opposed to base case, which would be 45, and bearish 46. Even their expenses, you know, we have a bullish case for their expenses, which the costs are obviously going to be smaller, and the bearish costs are going to be higher. We have multiple categories: adjusted EBITDA, income statement, cash flow statement. So all the things that we had before plus a lot more. So all these numbers, once you put them in, it gets you to a section on the bottom, kind of like the one you saw before. This company here, DOCN, and if you were bullish on DOCN and you truly anticipated that they were going to reach all the numbers that you had in your bullish thesis, your upside potential would be 158%. And let's look at the bearish compared to the bearish. Downside of 39%. So that was the risk when I got in this. I was not bullish or bearish, but I thought they were new enough, they had a good enough product that they were going to generate some excitement, and that's why I got into it as a growth stock, because I thought they were going to have that quick growth. I think they're in a very competitive industry, a competitive sector, but they had something new enough where there's going to be enough excitement and they were going to have that potential growth. So this is what I sent out. I never made a video, but I did send out, you know, my position at 53.97, and this is where it's currently trading at 73. And that's why I sent that alert out, which said I'm possibly going to close this because it's reaching my target. So does that mean it's going to reach this price and not keep going up? No, that's not what that means exactly. This is my thesis. I believe that they're good company, good enough to stay at the pace that they're on as far as growth, or my thesis doesn't give me enough conviction that they were going to reach that $140 valuation. Not within the next year right now. So maybe after a year, this company's still trading around this price, but you have one more year of information, you have one more year of revenue, one more year of cost, whatever cost them to cost of goods. Maybe after a year or two, I would reevaluate and maybe be bullish at that time or bearish. But right now, based off the information I had, based off their history, based off their past, this is where I was comfortable. So back to Intel, you know, once I've established, we looked at those Intel numbers and we found that they were undervalued. Then you have to start doing your research, start reading the 10Qs, 10Ks, and just see if the company is going to stay stagnant. Do they have anything down the pipeline? Are they expanding? Are they taking over other companies? Or are they doing things to show that they want to grow? Or of course, every company wants to grow, but they're putting themselves in position to grow. So there are a few things here that are possible catalysts. They have their foundry service, which they plan to invest $20 billion to 2 new foundries. They have their Intel acquisition Mobileye, which I feel like is going to work well with where we're heading towards with auto vehicles and self-driving vehicles. They have their new product here that's slated to come out the first quarter of 2022. It's going to make them more competitive with streaming, with gaming, with creating. So this is another possible catalyst. They've recently won a US government project. That was kind of the difference between value investing and that high risk type of swing trading. There were some lessons to be learned from FBRX. I hope you give me another chance to earn your trust. If you've been trading with me for a while, then you've seen the consistent growth, you've seen the positive returns, and we hope to get back to that. We've learned some strong lessons from FBRX. I'm going to do my best to not let a trade like that happen again, not put myself in a position to lose that much in one trade. INTC is my first call for value investing, value trade to have in your portfolio. Don't expect to see like a swing trade growth, like in 3 months, 2 months, a 20, 30% growth. This is not what value investing is. This is a company that you're going to hold for the next 2, 3, 4 years to balance your portfolio. You want to have a certain amount of companies from every sector. You don't want too much exposure to one sector. You don't want too much exposure to just one company. You want to have a well-balanced portfolio. So this is what we're building. This is the first stock. I'm going to have at least maybe once every 2 weeks or once a week a value play to add to your portfolio. This is in my portfolio, and I'm going to be holding it for a long time. Again, thank you for joining me. I hope you enjoyed the video. If you liked it, please subscribe, comment, and like, and see you on the next video.